Share trading and investment in stocks has gained a lot of popularity these days, thanks to trading apps and cheap and reliable internet. And with the income tax return filing season underway, it is imperative that the investors who trade in stocks file ITR detailing the income they earn from buying and selling shares. If you're not aware of the forms and clauses involved in taxation of income that is earned from selling shares, then you've come to the right place. Hello everyone, I'm Hemant Abhishek and welcome to a brand new edition of Paisa Wasool. And today we have a comprehensive guide on how to file an ITR for income from the stock market. Firstly, it is important to know that if an individual buys shares to invest, then it will be regarded either as a long-term or a short-term asset which is taxed as capital gains or losses. The gain or loss is calculated depending on how long the stocks are held. But if the shares were purchased with the purpose of trading or business, then it will be treated as business income and taxed accordingly. What are the documents required for filing such a return? Firstly, you will need Form 26AS, which contains the details of the income tax that has been deducted and deposited by your employer. Then comes Form 16, which the employer gives detailing the earnings, tax deductions and investments shown. Apart from that, in this case, you'll need interest certificates and statements of capital gains. These can be procured from the fund house or the investment app where the trades have been made. So which form should you choose? As per the Income Tax Act of 1961, the tax levied on gains arising from sales of shares depends upon different factors. These include factors like the period of holding the stock in question and the volume of these transactions. So a salaried person whose only source of income is the salary has to select ITR 1 while filing return. But the taxpayer will have to select ITR 2 form in order to report capital gains. And if they conduct trades as a business and that is their source of professional income, then they have to file the return via ITR form 3 in order to report capital gains or losses. What are LTCG and STCG? So capital gains are divided into two parts, short-term capital gain or STCG or long-term capital gain or LTCG. Let's understand these in detail. A seller makes a short-term capital gain or incurs a short-term capital loss when equity shares are sold within 365 days of purchase. And when shares are sold at a higher price than purchase price, then it implies that a short-term capital gain has been made. And when shares are sold at a price lower than the purchase price, then it is classified as a short-term capital loss. Irrespective of the tax slab, short-term capital gains are taxable at 15%. If the equity shares are sold after 12 months of purchase, then the seller can make a long-term capital gain or incur a long-term capital loss. Earlier, the long-term capital gains made from sale of equity shares were exempt from tax, but the exemption was removed in Budget 2018. After this, a seller making a long-term capital gain of over Rs 1 lakh has to pay LTCG tax of 10% plus the applicable cess. Also, for transfers made on or after 1st April 2018, the benefit of indexation was also removed. What is grandfathering rule? If you've been holding stocks from before February 2018, then it is important to note that under this provision, only the gains emanating from the 1st of February 2018 are considered for taxation. This is known as a grandfathering rule. And that's all for today. We will return in the next video with some more wealth and investment tips and tax saving tricks. Till then, goodbye, take care and keep wasooling paisa, because if it's not value for money, it's not worth it.